U.S. stock markets are absolutely ripping following Donald Trump's victory in the 2024 presidential election. Euphoria is at an all-time high, but can it last? And is there a lingering threat all the way on the other side of the world, namely China? In this video, you and I are going to discuss whether or not China could be the sleeping dragon that ends up destroying all of this euphoria in one big wake of disaster. Or if it's nothing to worry about and that this Trump presidency is going to be the best thing we've ever seen. Now, with that being said, if you like this type of content, economics, investing, finance, politics, consider subscribing to the page. With no further ado, let's dive in. China caution cools sizzling U.S. optimism. A look at the day ahead in Asian markets. Investors in Asia have their first chance on Monday to react to a batch of key economic indicators and news out of China, and should do so in a relatively bullish frame of mind after the record-setting rally on Wall Street on Friday. The S&P 500 rose above 6,000 points for the first time, continuing its powerful rally following Donald Trump's victory in the U.S. presidential election on Tuesday and the Federal Reserve's interest rate cut on Thursday. That sealed a weekly gain of almost 5%, the S&P 500's best week since September 2023. This helped lift the MSCI World Equity Index to a new high on Friday, too. As you can see, this chart right here, the S&P 500's journey to 6,000 points. Stocks have rallied despite a pandemic, decades-high interest rates, and economic uncertainty. You can see back in November 2020, you had the presidential election. Well, first, you had the bottom in March 2020. Remember this right here. You remember that. If you were investing at that time, I started investing in 2018. So I had seen some ups, as you can see here. And then around March, I started to get into crypto. And this was when I got a rude awakening as to what the markets can do to your money in a very short period of time. Boom! 33% down in 30 days. It was one of the most wicked crashes ever. Now, of course, you and I know why, right? The economy shut down. We were in unprecedented times. There were unprecedented measures being taken. So, of course, there was going to be quite the reaction. But then it steadily came back. Hits all-time highs again in the fall. This is when crypto started to rebound. And then bing, bing, bing. And then boom, we're off to the races. Index crosses 4,000. Fed starts the hiking cycle right here. So you had a pullback. Fed starts hiking. Down. Pullback or uptick. And then down. This was the bottom around the end of 22. This was because the tightening was going on. So the Fed increased interest rates and they were tightening the monetary supply. As in liquidity, which Raoul Pal likes to talk about on Everything Code and the Journeyman, I think is a very easy way to understand this. Liquidity was not increasing at enough of a rate. In fact, it was actually decreasing. And if there isn't liquidity being pumped into the system at a proper rate, or a rate that is going to allow investment to occur, allow assets to inflate, then this whole thing comes crashing down. Now, in this case, it didn't quite crash, but this is a pretty steep correction. I mean, you're looking at 46, 4,700, and then down, all the way to 35. 35 in short order. That is tough. But then you saw liquidity start to stabilize. It started to increase a little bit again. Not a ton, but a little bit. And then you see this rise. Pullback, rise. The rise has been crazy here. Now, I think this is probably because we started doing insane fiscal policy here. $100 trillion, or rather $1 trillion every 100 days. I was about to get those mixed up, but $1 trillion every 100 days, starting at this point, that might get you to this point where you have 5,000, 50 basis point cut, Trump presidency, you're at 6,000. It is worth recapping how monumental last week was for world markets. The U.S. election and Fed rate cut supercharged risk appetite and the dollar, while investors also navigated a UK rate cut, they've cut a couple times, and the collapse of the German government. Fantastic. The news flow from China was potentially no less significant for investors, although the outlook is not quite as uniformly bullish for local or risk assets. No, Chinese stocks are terrible right now. They are the worst assets on planet Earth other than high-risk debt instruments. I mean, seriously, their stock market is a pile of garbage right now. But that means there might be opportunity. You don't know. We'll see. China unveiled a 10 trillion yuan or $1.4 trillion debt package to ease local government financing strains, and stabilize flagging economic growth. But this will disappoint investors who had built up hopes for something special to preempt another round of fractious Sino-US tensions and trade barriers. And on Saturday, official figures showed that inflation in China remains weak, an indication that the economy's revival path and path to reflation will be slow and long. Yeah, reflation in China is going to take some time because I always like to say, you and I need to remember that inertia exists. When you have a trend in motion, especially when that trend has picked up a lot of steam over the course of a lot of time, as the case is in China, remember, they were locked down tight, sealed shut. They didn't reopen until 22, and then reopening was a flop. 23, you had another reopening, flop. You've had intervention after intervention after intervention, flop, flop, flop. Housing market, terrible. Big construction companies and big real estate developers out there in trouble. We remember Evergrande. If you don't, look up a video on Evergrande. Look up a lot of videos on Evergrande. Read articles, read stories. You'll see that China has had a lot of problems with consumer prices because everything around the Chinese economy is terrible. That trend is in motion, and it does not look like it is going to turn around anytime soon. You can see here, producer prices up, and then they have just fallen through the floor. Now they're stable, but you can see that they're not cracking above, right? If you want to say that this is a trend line, I'm just looking at it roughly. You want to say that this is a trend line or that this is resistance. If you want to get higher producer prices, well, down, tries to come back, and then we're down again. So where is it going? Probably down. You see consumer prices, pretty stable the whole time, but they keep just eking downwards. They're not going up. And at a certain point, you need consumer prices to go up in this debt-based economy. You can't have them go down, unfortunately, unless it's due to production. But production isn't happening. The economic system is not allowing for production to increase to the point where you can actually have deflation. Producer prices in October slid 2.9% on the year, deeper than the 2.8% fall in September, below an expected 2.5% decline, and the biggest drop in 11 months. Annual consumer price inflation slowed to 0.3% from 0.4%, the slowest in 4 months. While investor sentiment globally looks strong, because U.S. stocks account for 80% of all stock investment, so if the stock market is ripping in America, yeah, global sentiment's going to look pretty good because almost everybody's invested in the U.S. because it's a money-making fucking machine. Everybody knows that. It's also a great way to lose a ton of money if you're on the wrong side of the trade because the liquidity is insane. While investor sentiment globally looks strong, the optimism that exploded around China in the wake of Beijing's wave of stimulus measures in September is fading. Mainland China saw net outflows for the fourth consecutive week, according to Goldman Sachs. Jeff Snyder talks about this on Uredall University. He's far more knowledgeable than me. And when I say far more knowledgeable, I mean not one time, not two times, not three times, 10, 20, 30 times more knowledgeable than me. This is all he does. This is all he has done. That man is very intelligent. He understands what's going on. He's been talking about this. Every single wave of stimulus has faded in 3 to 4 weeks, maybe 8 at the most. They come out with something, a month or two later, we're back to where we were, and now we're sliding down again. While investor sentiment globally looks strong, the optimism that exploded around China in the wake of, SocGen analysts advise caution on China, noting that the risk of higher U.S. tariffs on China and other parts of Asia is very real, implying lower growth in Asia and a stronger dollar against Asian currencies. They now expect USD CNY to peak at 740. Wow, 7.4, that's insane. In the second quarter of next year, arguing that China's stimulus measures may not fully compensate for the increased tariff risk. The dollar is certainly on a tear and clocked its 6th weekly gain in a row last week against the basket of major currencies, something not seen since August through September of 2023. We need to discuss the dollar because I put out a video of that a couple days ago, perhaps a day ago. I don't know. I mix up the uploading schedule. I'm new to this thing. But let's just say this. If the dollar rises compared to the yuan, at a certain point, That's going to affect Japan. That's going to affect China. All of this comes down to borrowing costs. If you can't borrow money to get the things you need to pay back your outstanding debts and to buy the oil and the commodities that you need to keep your economy functioning, things get really dicey. So while the dollar being strong is quote unquote good on paper, we don't want it to be too strong. We don't want the dollar to be really, really, really weak, but we also don't want it to be super, super, super strong, because if the dollar is too strong, foreign countries will have trouble repaying their debts, because most debts outstanding across the globe are denominated in dollars. Therefore, a country like Colombia, a country like Turkey, a country like China or Japan, they need to get dollars to pay those debts back. So if the dollar rises too much, it becomes too difficult for these countries to pay back their outstanding debts. And if it becomes too difficult for countries and, more importantly, hedge funds, private equity, real estate developers in China, if it becomes too difficult for them to pay back outstanding debts, now all of a sudden you have defaults. And if you have defaults, since we are operating in a global system, as Jeff Snyder, as I previously mentioned, you should check out Eurodollar University, says, a globally synchronized system, one that goes up and then down in synchronization. If you have major defaults with major players in China or Japan or any other country that is getting a lot of capital or has a lot of high-risk capital in it, all of a sudden that comes back to the U.S. And when investors in the U.S. are losing money on commercial real estate in China, because there's a lot of incestual relations between those two countries we don't like to talk about, all of a sudden those big money players have to sell to cover their losses or to get capital to keep their firms running. When they sell, they're selling their winners. Stocks are up. So if there are defaults in China or Japan that come back to bite U.S. investors, they're going to sell stocks. They're going to sell gold. They're probably going to sell them at the same time. They're going to sell crypto too. They're going to sell these big winners that are on absolute tears. And when that happens, you're going to see prices fall. I'm not saying that's going to happen necessarily, but it's something to be wary of, especially since there's so much euphoria around the U.S. stock market and this Trump presidency because of the policies, because of the firmness of Trump, whatever that means. Very abstract, very esoteric. I don't know how that has anything to do with this, but the narrative around a Trump presidency is very positive for risk assets, as it should be in some ways. But in other ways, if it's too well done, it could have reverberating effects that are very difficult to measure and potentially impossible to contain. So with that being said, if you gain value out of this video, subscribe to the channel. Let me know what you think about all this. Where do you think stocks are heading? Where do you think assets are heading in general? Comment them down below. And that being said, I'll see you in the next video. Much love, peace. It's Nathaniel Knockel.